Hello and welcome to Lone Investor. We have a few things to get into today, so let's get right into it. So first off, nasdaq has a little bit of rally back to the 13K zone. And if you have been watching, I've talked about the 13.3K, 13K, and 12.5K as my buying target. And today it started at 12.7, so it's a little bit off from my 12.5K. Today in the morning, I did average down on Mara. As you have known, I bought Mara at $27 back in here when it touches the trend line. And I did not buy in when it touches this trend line. And now I bought in at 18, so my average is now 23. So when it gets back up to the trend line, which now becomes the resistance, I may sell a little bit just to keep cash, and I'll add back in when it drops by a little bit. And in the next few days, we have the big tech earnings such as Microsoft, Google, Apple, Amazon, and Facebook. And as I've talked about in my last video, if all 6 of them miss the earnings, then we might see it breaking the 12.5K support and maybe retesting the 12K support. And I've also said in my last video, and if the earnings are half and half, then we might see it bounce between 12.5 to 13.3K area. And if all of the earnings are good, we may see a strong recovery until the FOMC meeting next week. And as I've mentioned, the market is already pricing for 75 basis points. So we might just see a little bit of dip on the FOMC meeting. And if 75 basis point is confirmed, we'll see the market rally for a little bit more until the inflation data is released. As for the US dollar, I have talked about the 101 resistance zone. And since last Thursday, Powell saying they might increase to 75 basis points instead of 50. So the market is now pricing it into 75 basis points. So which pushes the dollar a little bit higher for the past few days. As for our emerging stock, for example, Alibaba, I've talked about this previously. It's now almost filling up the gap completely. So the risk-reward ratio is actually not too bad as of this moment. As for the 10-year bond yield, we did talk about it being overextended at the 2.9% level. So right now we're seeing a little bit of pullback. If we continue to see a dropping for the bond yield, it will benefit the tax stock later on. As for oil, back in April 12th when the CPI data released, I was saying that the CPI data will be high compared to the last month, and which will bring people flocking in back to oil, which will then see a little breakout. And I also said that I will feel more comfortable getting in when the oil touches the previous high of this level. And then during the Sunday, we have a news here on Libya, which pushes the oil a little bit higher. But in the short term, I still believe oil will come back down. And as you know, for the inverse oil ETF for SCO, I got it at 4.9, and then this drop was the day for the Libya issue, which pushes the oil up. So it was April 18th, and then I saw the SCO on April 19th at 5.25. And I was saying that I'm not very updated to geopolitical news, so I just quit the oil trading for now. But technical wise, it should close this gap as I see oil dropping, and which oil did fall back to the 95 level, and which we did see the SCO closing in the gap. So congrats to those follow through. And oil currently, it seems like having a little consolidation forming again on day chart. And a lot of people might see it as a bull flag for oil to go up. And as I've mentioned before, with China still being in lockdown, and even though there are sanctions to Russian oil, but China and India are buying the Russian oil. So if they're buying from Russia, they might not buy as much from Saudi Arabia. So I think the overall oil supply doesn't really disrupt as much as we thought. So on the overall standpoint, I think oil should come down back to 85 level in order to have a healthy correction. And I want to spend a little time talking about gold today. So gold has been jumping quite a lot recently for the past few days. And part of the reason is because of the stronger dollar. And since gold is tied to the US per ounce in most of the countries, so in foreign countries, they will be spending more of their local currency to buy gold, which will make gold seem like less of a attractive investment. So you could also argue that when the dollar starts to come down, it might benefit gold as it is more appealing to the foreign investor. But either way, you can consider opening up a position at the 1900 area, as if we put the retracement on top, it is almost at the 50% level, and it is a good hedge against recessions, which I believe it will come in next year or the year after. So if you're considering getting some gold in your portfolio, so 1900 is not a bad price for opening up a position, and the next price to any heavy will be 1820. And when the stock market does have a rally to all-time high, then gold will be more likely to consolidate within a certain zone. And when that happens, you might consider exiting your stock position when it reaches the all-time high. And if gold happens to reach under 1800, maybe to the 1750 level. So slowly switching to gold is what I'm planning to do in the next few months ahead. So with that said, for the next few days with the big tech earnings, we do expect to see a little bit more volatility on a certain range. And next week we have the FOMC meeting. So until then, the market might be going green and red every single day. So this is it for today. If you like the video, do hit that subscribe button and give me a thumbs up. And I'll see you guys next time.